Hello, everybody, and welcome to Taxmas, otherwise known as the Australia's Federal Budget 2026-27 and Tax Nuggets Academy's Federal Budget Review. And OMG, Jimmy really took the opportunity to make some massive calls, replacing CGT discount, negative gearing, discretionary trust, instant tax deduction. I'm just mind blown. Anyway, can't wait to dive in and explore the changes with y'all. If this is your first Tax Nuggets event, welcome. You're about to discover why more than 8,000 accountants all over Australia prefer to do their tax learning with us. And to our subscribers, hey Nuggeteers, welcome back and thanks for joining us once again. Today, you'll also be walking away with your own cheat sheet of all the need-to-know reforms. It's simple and clear and focused on SME and private clients. So we'll be dropping links to that in the chat throughout the session today. So for those that don't know me, I'm Joyce Ong, founder and CEO of Tax Nuggets Academy, and I will be your host for today. Just a bit of housekeeping. As usual, all our chats are open for you all to interact with each other, interact with myself and our assistant Nugget, who is in the back end helping out, aka Vicky Tang. So feel free to say hi. Let us know where you're joining us from today. I'm based in Melbourne, which is looking pretty sunny today for a change. We'll also be launching a few different polls here and there throughout the session today, and please I encourage you to participate in those because it'll be fun. If you have any questions, though, make sure you put it in the Q&A section and not the chat, because I want to look out for it. The chat will get pretty busy today because there's almost 3,000 registrants. So help me out there. And also, this session is being recorded, and you'll get a copy of the recording, slides, and the cheat sheet after the session. And as usual, we always give away a bit of merch. So if you want a chance of winning this very special limited edition personalized mug, please make sure you pay attention to the webinar, because it is a little bit of like a quiz, sort of. And stay tuned until the very, very end. All right. Just for those that are new to us, we are an online tax training platform made especially for accounting practitioners focused on SME and private clients. I'm just going to launch a quick poll here to see who is already familiar with us. Let us know while I just tell you a bit more. So I started Tax Nuggets Academy because practicing accountants, myself included, back in the day, we have a mountain of work to do. And the last thing we want to do is CPD that is like watching paint dry, which is why Tax Nuggets is all about just-in-time learning and not just in case. Because I don't know about you, but I can hardly remember what I ate for breakfast 2 days ago, let alone a webinar that I've done 2 months ago. Which is why our platform gives you unlimited access to this huge library of recordings from over 50 top experts. And you can easily search and find and learn exactly what you need at exactly when you need it. Like the federal budget before you have a client conversation about the budget. So it's kind of like Netflix for tax, and it's a resource library that you can give, to your staff, and they can tap into to increase their confidence and competence without draining senior staff time. And we also bring you the most engaging presenters in the industry, like the one I'm about to introduce to you. So Andrew is the co-founder and managing director at Velocity Legal, specializing in complex tax issues and disputes for SME businesses and private clients. So please put your emoji hands together to give a very warm welcome to Andrew Henshaw.
with the sunglasses on.
Yep, it's definitely a party, and a pretty messy one, potentially. How many hours of sleep did you get last night?
Somewhere between 0 and 8, and I'm running on pure adrenaline. We went on looked at the budget, downloaded the papers straight away, read that, scratched our heads, chatted internally in our team, wrote some stuff, slept on it, and thought about it in our dreams. Now we're here.
Yep. There's a lot of dreaming about it, I can imagine. You would be wondering of all the beautiful restructures that you can do to get out of a trust structure, potentially.
Yeah. It's,
Well, what's on the agenda?
Oh, look, it's a huge agenda because it's a huge budget. I've been doing these webinars for a few years now, and we've generally had to sort of scrounge around to get material, but this year is absolutely not the case. There's a huge amount of stuff on it, and some really, really big ticket items. So I'm going to go through those. I'm going to spend more time on the things that I think are more important, and less time on the other things. So big ticket items, we've got CGT reform, negative gearing, and the death knell of trusts, potentially, discretionary trusts. Those are the 3 big ticket items, but they're not everything. There's a lot of other things as well. So we've got some things for individuals. We've got instant asset write-off. We've got some loss measures, FBT changes, and R&D changes, to name a few. So it's an absolute jam-packed agenda.
All right, let's dive into it then.
Great. Well, I'll start off with, which I think is probably the biggest ticket item, is CGT reform. Now, this was widely anticipated. You know, you could have picked up the AFR on any single day in the last 3 months, and there'll probably be a headline on CGT. Are we going to go to indexation? Is this game going to change? What's going to be in? What's going to be out? All those questions have finally been answered. We're going back to indexation. So the measures announced are to apply from 1 July 2027. From that date, in general, the 50% CGT discount will be replaced with the cost-based indexation. I remember learning about indexation at university. It ceased to be relevant, or it was frozen in time in 1999. So I never really had to apply it in practice. But going forward, we'll be on an indexation model. So in other words, your cost base will be indexed by CPI. That's not all. We also have what's being called a 30% minimum tax on net capital gains. And I think what that's really getting at is if you've got otherwise a sort of a low, normally you'd have your net capital gain, it would then flow into your assessable income. Maybe you have revenue losses. Maybe you have no other income, and your effective tax rate's much lower than 30%. What's proposed is that there'll be a minimum 30% tax on net capital gains. These measures will apply across the board, individuals, trusts, partnerships. They don't seem to apply to companies. No, companies aren't mentioned. It's worth noting companies aren't eligible for the 50% discount in the first place, but the indexation won't be available also to companies. So there still will be some difference between individual trust partnership versus company, albeit much less, I think. This will apply to all assets. If you read a lot of the stuff, the headlines and all this stuff, it's about property ownership. And it's cute to say it's property ownership because everything's property, I guess, but it's not. This is not just going to be residential property, existing residential property. It's every single CGT asset other than new residential property. Goodwill, shares, units, business property, everything, all your CGT events that apply all the time will presumably just be cut out of the 50% discount.
Yep. Quick question from Mark, the 30% minimum tax. Does that mean you don't get the tax-free threshold benefit?
Yeah. That's
gone.
Yeah.
Yep.
There's an explanatory, there's some explanatory papers, I guess, to some of these measures. And it's very clear that that's the intent, that someone, from a policy perspective, what they're saying is you should not be able to drip a capital gain out and use tax-free thresholds, et cetera, et cetera. You need to pay a minimum 30% tax.
Right.
So I haven't crunched the numbers about when 30% is the average. The rationale in the papers is that that's the tax bracket that applies from 45 grand above of income, and therefore, I guess just from a policy perspective, that's the rate that should apply at a minimum. You can argue about whether that's correct or not, good policy, bad policy, but that is what is proposed.
Yep.
Now, this also includes pre-CGT assets. Now, pre-CGT assets these days are few and far between, mainly because, one, that's 42 years ago. Transactions have happened since then, 41 years ago. If assets are held individually on death, you lose pre-CGT status. So your only times you're ever going to see pre-CGT assets now are people who are over roughly 70 years of age at a minimum, or perhaps in a company or a discretionary trust. And there's various integrity measures and complications there as well. But they do exist, and they I guess they're sort of the holy grail in tax world, because everything that's happened since 1985 has always need to grandfather those assets. And I think I made a comment a few years ago saying, why are we still grandfathering this? Like, we don't get that treatment on other things. And certainly none of the things in here have that treatment more generally. They might have a little bit of a leeway, but it's a very, very long time. And there's even now, there's cases and disputes about pre-CGT status because so much is on the line. This will include pre-CGT assets. They are being brought into the net going forward. The next slide, I'll talk about how, but they are being brought into the net going forward. Finally, on this slide, one really interesting point is that it seems that, so for non-residents, they haven't been able to access the 50% CGT discount for last 14 years, ever since 2012. It seems that non-residents would still be able to access the indexation model. So if you are a non-resident or advising a non-resident, they're potentially actually better off under this than under the existing law, which is a bit perverse, but that seems to be the outcome. So I'll get into the transitional rules, because I think most people will have questions immediately about, okay, how is this going to apply for existing assets? The regime is proposed to only apply essentially to gains on it from 1 July 2027. So if you've got a pre-CGT asset and it's disposed of before 1 July 2027, it will remain exempt. And I'm not sure if this detail was made crystal clear, but I would expect that it's the date of the CGT event, which is a different date to settlement. So you work out what's the date of the CGT event. I think, so if you've got a pre-CGT asset and the CGT event happens before 1 July 2027, current rules. If it's a post-CGT asset, again, current rules. You'll apply the discounts as you applied them to date. I think one practical thing we're going to see from this is an absolute flood of transactions between now and 1 July 2027, because until that point, we're under the old rules. That's not to say that, there's a massive cliff that people are going to drop over on 1 July 2027. What will happen is that, I can just see there's some typos in this slide, not 2017, 2027. What will happen is essentially we'll move into some transitional arrangements. And what the government have said is that there's going to be two options. Either you can get a valuation as at 1 July 2027, or there's something they call the specified apportionment formula. So in other words, you acquire an asset, and you sell it, you own an asset now, you sell it before 1 July 2027, you're not in this new system, you're in the old system. You buy an asset on or after 1 July 2027, you're in the indexation system. If you bought something before 1 July 2027 and you do it and sell it later on, there's essentially an apportionment. So everything up until 1 July 2027, looks like you can choose between these two methods. Whenever these are done, this was done also for foreign residents and the 50% discount back in 2012, it opens the door to a valuer's field day.
They're one of the biggest winners
I
of
think
this
so.
budget.
I think so.
Yeah.
I think
Very
so.
June 2027 is just a field day for them, right?
It's easy enough what's very easy for listed securities. That's not hard. Easy enough for property, but the real complex gets into other CGT assets, particularly private businesses. That becomes,
And I have done several calculations for the foreign resident one. It is not fun.
No,
It is extremely complicated to apportion pre and post.
Absolutely. Just to give some examples to these, I've taken the examples directly from some of the budget material in the goodness of time. So 2 examples of how this works in practice. Firstly, we have Zoe. She purchases shares in a company for $100 on 1 July 2027, and she sells them 5 years later for $125. Having made a nominal, I don't know why they're using the word nominal, having made a gain of $25 from the investment. They explain that as the shares were purchased after 1 July 2027, it's subject to the cost-based indexation, inflation's 2.5%, and the index cost base is $113. So in that example, essentially Zoe's cost base is now $113. And her actual capital gain is not $25, it's $12.
How did it calculate 113?
No idea.
Some sort of compounding.
ATO tools, magical ATO tools. That's what it says.
Oh, okay.
Yeah. No, I don't know. I imagine that there's, like in the age of tech that we're in now, I imagine, working this out actually won't be particularly difficult as compared to back in the 1990s, presumably. I was practicing at the time, but so I'm told. They say that in this example, that's actually just less than the gain under the 50% discount and should actually pay less tax. Now, that might be a very convenient example, but that's the example used. We then have an example for the transitional arrangements. We have Jane. She purchases an asset 1 July 2022, $800,000. She sells it 10 years later, 2032, for $1.6 million. And again, using ATO tools, this is this specified apportionment method, I think. It's determined that the asset's worth 1.131 as at commencement date of the policy. So assuming that figure, then essentially I think about it as Jane has 2 capital gains. One is the one that you can apply the discount to, and one is the one that you have to apply indexation to.
Yep. Great. Can't wait to see these ATO tools.
There is an exemption. There's one exception to this, and only one exception. It's new residential property. So if you're purchasing new residential property, you essentially have the choice between the two. You can choose the 50% discount if you want to, or you can choose this new cost-based indexation plus minimum tax. So it's drawing a very clear line between the two. And essentially, if you've got new residential property, you're actually better than under the current system because you can make a choice. And I'm not sure this detail is made clear yet, but I would expect that you can make the choice when you sell the asset because that's usually how CGT principles work. You can make the choice at the end so long as nothing's inconsistent with that. So for new residential property, you're actually better off under this going forward. What about small businesses and startups, I hear you say? Assuming that's in the comments at the moment, but
A lot of comments
yeah,
around
okay,
this.
good. My practical takeaway is this makes the small business CGT concessions more important than ever, because under the existing law, we already had a difference between, okay, you're in the promised land, the small business CGT concessions, and if you just fall outside for whatever reason, you don't get any of the concessions. But at least you get the 50% CGT discount, right? If we don't have the 50% CGT discount and we have indexation, and we're indexing a nominal cost base of $1 in shares, then you can index all you want, but you're never going to get you're not going to get a high figure. So indexation is not going to help you particularly if you're a startup business. Firstly, I think it makes small business CGT concessions more important than ever. The papers do say, they say the main residence exemption will continue. No changes there. And the 4 small business CGT concessions will also be unchanged. So business as usual, other than the fact that you can't apply the general discount under the concessions, business as usual for the small business CGT concessions. But what about all those other situations? As I said, not everything falls within the small business concessions. Maybe you're a founder and you got 15%, or you flick over the turnovers, that sort of thing. There was a lot of lobbying, a lot of press before the budget about the startup sector, tech, etc., about employee equity, really, because one of the reasons people give businesses that give employee equity is to incentivize, right? And one of those incentives is the growth is on capital account. And I was quite shocked when there was nothing actually in the budget about tech startups. You have to go to some explanatory material which says so there's nothing in the budget about it, the papers themselves, but there's some explanatory material that says that the government's going to consult on what this means for early stage and startup businesses. Now, I don't know what that means. There are some CGT concessions available for startup businesses, early stage innovation companies, which is the ESIC rules. I don't know if it's talking about that, something more broad. I imagine that I think they're getting a lot of heat on this, and I imagine there will be something, but I don't know what it's going to be. Maybe we've got something separate to the small business concessions, the early stage and startup business concessions. But until such time as we see it, we don't know. I don't know.
Yep. And that's just CGT.
That's just CGT. CGT is one of the biggest ones, but that's just CGT. I'll move on to talk about negative gearing. Negative gearing will be banned going forward. Banned.
Put very simply.
Yes. So from 1 July 2027, you will only be able to offset losses from established residential property against residential rental income and or capital gains from residential property. So essentially, it's not banned, but we're moving to a quarantine method where if you've got losses that are from existing residential property, you have to put them over to the side, and the only thing you're going to be able to use for those losses is residential rental income and residential property capital gains. I don't think it's as specific as the property itself. I think it's just the asset class, but it's a carry forward and it has to sit there. Transitional measures, if it loads. This applies to properties acquired from budget night. This is one of those good old-fashioned budget night announcements with effect from 7:30 p.m. on budget night. Importantly, existing investments are fully grandfathered. They're not brought into this. They're not proposed to be brought in. Government may change their mind 42 years' time, like pre-CGT, but it is proposed that they'll be grandfathered until such time as they are disposed of. So you can continue to negatively gear and offset rental losses against other income. So any contract signed are also protected as well. So is there a contract by 12th of May 2026? If yes, you're in the old rules. Carve-outs, the main carve-out, there's carve-outs for a couple of different things, but the main carve-out is eligible new builds. They haven't used the term new residential premises. And I'll read the budget and I'm like, eligible new builds, what's that? It's essentially, it seems to be a smaller subset of new residential premises. And I think the reason for that is that new residential premises can cover things like renovations, for example. You can bring something into being new residential premises. So in the explanatory materials, there is a table that explains the difference between the two. So the things that are eligible new builds are off-the-plan apartments, knockdown and rebuilds of duplexes, building on previously vacant land. Those are the things that are eligible new builds. The contrast is the other stuff. It's extended. There's just they're just knocking down one house and putting a new one up. They're building granny flat, that type of thing. It's really getting at encouraging housing stock, because you can see with these two measures combined that if you're leaving aside the transitional measures, if it's new residential premises, you're going to be giving it your discount and you're going to have negative gearing. If it's not, you're not going to have either of those things. I'm simplifying, but that's the general premise.
Are these new rules applicable only to residential property?
Right. Yeah, residential property.
So commercial property is still fine. Other asset classes, shares still can negative gear?
Yeah, you can.
Normal?
It's more just that the benefit of doing so is probably far less because of the CGT discount being there.
Yeah.
Now the third big ticket item, I think this is I'm debating in my head which one's bigger, CGT or the discretionary trusts, because they're both huge. If it was a heavyweight battle for the world title, it'd be between these two in the budget. So I'll get into this. 30% minimum tax. It's quite nasty. And I think my starting headline comment is this might be the final nail in the coffin for a lot of discretionary trust structures. Less so owning shares in a company, but in everything else, it may be. Depending on the situation. It's not for everyone. It's not going to be like, oh, it's not going to be any discretionary trusts anymore. A bit more nuanced than that. So what the announcement is that the trustee will pay a 30% minimum tax on trust taxable income. Right, so starting point, normal rules at the moment, leaving aside this budget announcement, is that the trustee retains, it's got to pay 47%. If the trustee distributes to sort of non-residents or people with disabilities, it pays the tax on their behalf. But otherwise, it's the beneficiary who pays tax. They pay tax on their share of the income of the trust estate based on the net income. This will flip that around, and essentially it doesn't quite move it to sort of like a company franking credit type model, but it's not that far away from it either. So again, starting point, trustee will pay a minimum 30% tax on trust taxable income. Here's the sting. Now, some beneficiaries will receive credits for that, but not all. If you're a non-corporate, you'll receive a non-refundable credit for that. So if they've got a discretionary trust and it's distributing all to Joyce, then whatever tax the trustee pays, so the trustee pays a 30% tax, then Joyce will get essentially a non-refundable, let's call it a franking credit for argument's sake, non-refundable franking credit for that. Tax rate might be higher, but she won't get a refund on it, but that will be, yeah, that's sort of okay. It's not really that much of a change. If it's a corporate beneficiary, it will not receive any credit at all. I didn't quite pick this up straight away when I read the paper because I thought, oh, is this getting at some sort of integrity measure? And it was only like when I thought about it overnight and I read the explanatory material, is that this is intended to kill the bucket company. This is the death of the bucket company. I'm not overstating. I'm not exaggerating on this. How it will work is, let's say a trust has $100 of income, and it says, okay, let's send it to the bucket company. So firstly, the trust pays a 30% minimum tax. So that's $30, call it. And the bucket company gets essentially $70. And it pays tax on $70 at its rate. So you don't get a credit. It's not like the current rules where you would just, well, there wouldn't even be one in the first place, but yeah, you're not getting a credit for that. It's not quite like a franking credit. It's other beneficiaries will get it, but corporates will not. And I think it's quite genius of Treasury, to be honest, because, and I say that, I'll explain why I say that. We've got this Bendel litigation running at the moment, right? And everyone, including myself, is like jumping up and down about the outcome of that. And I'd always thought, oh, well, even if the taxpayer wins, the government's just going to say that going forward, UPEs are loans. I thought that was how they're going to do it. But they don't need to now. Potentially they don't need to, because why would you distribute to the bucket company in the first place?
Yeah, you're getting taxed at 60 cents in a dollar if you distribute to a bucket company, right?
Yeah, you'll pay more tax. So it won't stack up. If this goes through as announced, and of course, wait until the detail before advising clients on this type of thing. It's scheduled to be from 1 July 2028. There's a bit to play out in this, but if it goes through like this, it won't make any sense. I'll say, I think ever, unless there's some non-tax reason or something, to distribute from a discretionary trust to a corporate.
And there's no carve-outs for this rule that companies don't get a credit? What if it's an active business?
No.
What?
No carve-out.
What?
No.
Okay.
Yeah. Yeah, I can just see all the questions coming through about it, but I'm as mind-blowing as everyone else is.
You have to restructure then. So even if it's a legitimate business in a company that relies on trust distributions, you've got to restructure out of it.
And that goes to the next, or actually, no, it's a couple of slides time. I'll come to that. They have announced some things around that. Firstly, what are the exclusions? They're not discretionary trusts, fixed trusts, widely held, super funds, special disability trusts, deceased estates. Someone made the joke around, well, we're going to just keep a deceased estate going forever now because there's no point winding it up. I imagine there'll be some sort of 3-year rule around that for deceased estates, but I don't quite know. There are some exclusions of the income from this. The main one is farmers. If anyone's got a long enough political lens, these type of things have been proposed previously. I think the 1999 one was the biggest one. And one of the reasons it sort of got killed off was the effect it would have on farmers. Primary production income is excluded from this. So if your trust has only primary production income, then it's not covered by this. This is another layer of complexity that essentially, well, okay, if it's primary production income, you can still use a bucket company, for example. Or that more correctly to say that the trustee wouldn't have to pay the 30% tax, and you can essentially, the strategies remain the same as they do now. Other exclusions, if it's income to non-residents, that is excluded. If it's income from assets of a testamentary trust that exists as at 12 May 2026, that is excluded, but presumably that means that new testamentary trusts are also brought into this. They also have to pay essentially the 30% minimum. They have also said that certain income related to vulnerable minors is also excluded. It's not explained what that means. I don't know if that's getting at, like, there's a whole list of disabilities for unearned income exclusions. I don't know if it's getting at that or something else. That's what the announcement says. I haven't found anything to explain it. Trust restructuring. So it's very clear that the government has said you should be restructuring out of discretionary trusts. That's isn't said in those words, but effectively that's what it's doing. And what has been announced is that there'll be expanded rollover relief for a 3-year period, 1 July 2027 to 30 June 2030. This will allow some people, I don't know who, small businesses, to restructure out of discretionary trusts. Now, you might say, well, look, aren't there already ways to do that? Yeah, there is absolutely ways. There's a whole bunch of them. Jump on Tax Nuggets. There's a lot of seminars about all those other things, including some by myself. There are ways to do that right now. They all have conditions. So I don't know, and it's not clear what this expanded rollover relief is. Maybe it's bigger businesses or loosening something. I don't know. All it says is we're going to consult on this expanded rollover relief. And then overlaid upon that, you have other issues. You have in complicated groups with different test individuals, you have family trust distribution tax issues potentially. Presumably they'll be turned off. But then you have other things like state taxes. Some states do levy a duty on business goodwill, for example, Queensland, for example. And also you've potentially got real property as well. Look, as a lawyer and someone who advises on restructures, I'm going to be busy over that window. If this goes ahead, then it'll be. I can't see that there'll be any businesses left in discretionary trusts because you can't cap tax at 30%. There's no way of doing it.
Yeah, it's better to create a company and it's a
Yep.
SPE 25%
Yep.
potentially.
Yep.
Testamentary trusts, Andrew, are they
Yep.
excluded?
They are excluded if the testamentary trust has been in existence as at the announcement. So I guess if you've got an existing testamentary trust, it will be excluded. I think if it's a new testamentary trust, it isn't. Maybe some of the income, depending on who it goes to, might. But I don't know if it's going to be as good as just like the current treatment's anyone under 18. It's great. It's like one of the best tax planning avenues. I guess we'll just wait and see about that, exactly how that's going to work.
Yeah. And just quickly on that example that you provided, trust makes $100 taxable income, pays 30% tax. But then, it still distributes $100 to the company, right?
No
And
one
the
knows.
company gets taxed at 30% on the gross, right? 100, as opposed to the 70.
Under conventional principles, yes, but no one actually knows the answer to that. So
Yep.
there's really no point speculating on whether it's 70 or 100. It doesn't really matter. The point is, even if it's 70, it's still bad. So yeah.
Yep.
Yeah.
Still
It
bad.
depends how bad it is. Yeah.
Yeah. Really start thinking about the restructure. And I think this is the most complex part of the budget, isn't it? The uncertainty and clients wanting to know how can they get out of it.
And I think this one is proposed to apply from 1 July 2028. And I don't want to get political about it, but this is going to become a political issue. I can't see, I think it's going to be, and then there's going to be uncertainty about whether it actually goes through or not. We're going to have, I think, an election in early 2028, and potentially it's going to be, if we have a change of government, this isn't going to go through, versus if we stay with the current government, it is going to go through. So it becomes very hard as an advisor because, what do you tell clients? You've got to explain all that. So yeah, fun times ahead.
Absolutely. What's next?
Next. So there are still some other important announcements. I'm not going to spend obviously as long on each of them. So I'll start with non-individuals. Firstly, we have what I've just blanketed together as funding and powers. They're not huge figures. There's some stuff around fraud detection and prevention, a dynamic PAYG installment. I understand you could businesses would be able to sort of do that monthly, changing their PAYG installments, and some powers around tax debts that are caused by fraud. there's been some very harsh situations where the ATO says, well, I can't do anything because I don't have any power under the law to do anything with that tax debt. This suggests that there'll be some sort of powers, some discretionary powers available to the ATO in those type of situations. The instant asset write-off. I have to find something new to put in future budget announcements, because every single budget announcement since I've been doing this has had some sort of instant asset write-off being extended, temporary full expensing, et cetera, we've finally have now a permanent instant asset write-off. So from 1 July 2026, it'll be 20 grand instant asset write-off made permanent in legislation. We don't have to do this thing every year where we dance around about whether it's in or out. We all know it's going to be in still, and then we've got to wait for the announcement. Then it takes another 6 months of legislation to pass. So that's gone. It's a $10 million aggregated turnover threshold. So just some good news.
Yep, finally. I saw 2 clappy hands. So accountants are happy with this one because it actually reduces uncertainty.
Yep.
There were definitely no clappy hands in the first 3
well,
budget announcements.
Faults and rage, but don't direct them at me. I'm just shoot the messenger. So you have dynamic PAYG installments. I mentioned this, that SMSEs can essentially opt into monthly installment reporting and payments, to giving some, I guess, greater flexibility. I mean, installments are just installments. They don't change your actual tax payable, but just the timing of it. Loss carryback. This is one I didn't see coming, but some people might remember in the COVID years, there was a loss carryback mechanism that was put in place for a few years. I think it was 2019 to 2023 was the period covered. Essentially, we're going back to having loss carryback rules, where going forward, companies with aggregated global turnover under 1 billion, so pretty high threshold, they can carry back a tax loss against tax paid up to 2 years earlier. Now, it's only revenue losses, it's limited by franking account balance. You'd expect to see those things there. But there is some good from this, so that if the business had a big loss the past year or the previous 2 years, then you can have some smoothing out of that and not having to worry about trying to keep the losses going forward. So I think this is actually a good thing because there's so much complexity over losses generally. And if you can have a measure to sort of smooth out losses and bring them down, it reduces the need or the stakes on all these rules about are losses available in the first place. Another one I didn't see coming is startup refundable loss offset. Interesting name. This is geared at startup companies. And reading the budget announcement, it seems that that's company within 2 years of incorporation or operation, let's say, with aggregated turnover under $10 million. If they generate a loss in the first 2 years or first year or 2 years of operation, they can actually generate a refundable tax offset as a result of that. That offset is capped essentially to the tax that they've paid on wages. So what they say is FBT and withholding tax on wages. So it's not as simple as just carte blanche, whatever your losses are can be offset, but you will get a refundable tax offset basically to the extent of the capped at the wage cost, the tax on the wages that you've paid. So I'm not sure it's going to make a huge impact. It's something, but I don't know if it'll make a huge impact. FBT, this one people probably already across. It was announced previously. It's been included in the budget. Anyway, this is the from 1 April 2029. We have the change of the rules on FBT. We're moving to this permanent 25% discount on electric cars. that are up to the luxury car threshold. So that's a change that's already announced. Also already announced was transitional measures, particularly around electric cars under $75,000 that are provided before 1 April 2029. So go out and buy your Tesla, BYD, other EV. You've still got just under 3 years to do so.
Do you expect that to be grandfathered once it's purchased, before 2025?
It seems that that's the intention, yeah.
Yeah. Awesome.
R&D. Now, I don't personally do a lot of R&D, but a couple of colleagues do. This is sort of a bit of a mixed bag of reform around R&D, which is proposed from 1 July 2028. It's sort of a bit take with one hand, give with the other, is sort of the overall impact of it. One big ticket item is that supporting R&D expenditure is no longer going to be eligible. So with R&D, you've got the core activities versus the supporting no longer eligible. There's some, and the main other point is that the turnover is being increased for the highest offset rate from 20 million to 50 million. So there's some things being taken away. There's some extension of some of the thresholds. Individuals, there are some other measures covering individuals. We've got an extension on the foreign buyer ban. This was something announced, I think it was in the 24-25 budget. But there was a ban essentially for foreign purchases of established dwellings. That was due to run out on 31 March 2027. That's been extended to 30 June 2029. All the general exemptions continue: permanent residents, New Zealand citizens, spouses, etc. The rules still exist. It's just an extension of the ban. Well, $1,000 instant tax deduction. Again, this was something announced beforehand. There was legislation that's already been proposed for this, but it is in the budget regardless. So it's been called an instant tax deduction. So I'll go with that terminology. If you're an Australian tax resident, you derive income from work, then you're entitled to a $1,000 deduction. So the way I think about it is you can claim the higher of two things: one, $1,000, or two, your actual work expenses. So it creates a decision point. I either claim $1,000, or if I want to claim more than that, I need to substantiate everything. There are exclusions for donations, union fees. There are other things that still can be claimed, but and I expect you. I think this makes sense. It's a red tape cutting measure. I don't think anyone's going to get audited over a $900 deduction anyway. But yeah, so we've got the $1,000 deduction going forward. We've got the working Australians tax offset. I don't know why this is made as a tax offset. Like, why don't you just change the rates and do it that way? But hey, we've got the WATO. So it's a permanent annual tax offset of $250. It applies to individuals deriving income from work only, and perhaps that's the reason why it doesn't change the tax rates. So to get the offset, you need to derive income from work. That could be sole trader work. That's probably about enough to say about that.
Yeah, just going back to the $1,000 instant tax deduction, when does that start?
Good question. They've got legislation up, and I think it's after the legislation gets through. That, or it could be 1 July 2026.
Yep, all good. We'll Assistant Nugget, would you mind just checking that out, please? And yeah, thanks for everyone who's also replying in the chats. Thank you.
And we've got the stage 3 tax cuts, which is still going ahead. It wasn't in this budget, but it was in the previous budgets, just reducing some of those rates. 16 to 15, 15 to 14. But of course, those rates, particularly with these changes on the minimum CGT tax, on the minimum trust tax, will have less benefit for some than others. So for salary and wage, yeah, they're going to get the benefit of those. But potentially in other situations, you may not get any benefit from that anyway. Joyce.
Awesome. Thanks for that. What was your key takeaway, Andrew, from all of that? If you were to just summarize everything into, the biggest takeaway for everyone here today. And for those that are on the chats, feel free to chime in. What was your number one biggest thing from the budget?
Look, I can't distill it down into one thing. So you're gonna indulge me with a few things. I think firstly, expect lots of calls from your clients if you haven't already got them. I've already got a number of emails this morning saying, "Oh, that thing that we were doing, just hold fire on that because we just want to, this changes everything, or we want to think about this, etc." So that's the first point. Expect lots of calls. I think it's difficult when if you're having those structuring conversations. Seems to be very difficult to ever suggest a discretionary trust, or maybe not ever, but I think it's go for companies. And the third one is that if you've got clients with existing structures in discretionary trusts, start having those conversations. Most accountants I speak to that do have businesses running through discretionary trusts, they've already had conversations over the last 10 plus years about moving out anyway. And this is probably going to be the thing that will finally do it.
Yeah. I have an old bet with my old boss. Which one will come out first? A minimum tax rate for trusts, 30%, or Div 7A reform? I said Div 7A reform because obviously, right? I've been talking about it for 10 years. But yeah, he won.
I would have said Division 7A reform as well. I would have thought that's I'm with you.
I know, it's a shock, isn't it? Yeah, this 30% thing.
We have no Division 7A stuff in the budget. I didn't have a slide about what's not in the budget, but no Division 7A stuff. Nothing to do with family trust distribution tax and some of the nasty situations you can see there. Nothing on any of the other things that I haven't already covered. So your main residence exemption is still there, your CGT discounts. So your CGT concessions are still there. Division 7A hasn't been looked at. It's just going to create another layer of complexity, to be honest, because the fact that you've got transitional rules, you've got then all these exclusions, you've got structuring. People are already talking about, oh, well, I'm going to have a split classes of shares in a company, get around the rules that way. It's an exciting time to be practicing tax. I think if I can make it inspirational, then that's what I will. That's what I'll say.
This was not the tax reform I had in mind.
Yeah, I don't think it's full-scale tax reform either. It does a lot of stuff, but if you were actually doing a full-scale tax reform, there's other things you'd need to do or that would need to be considered as part of it. Because really, the income tax rates aren't changing. The thresholds are not changing. We still have a 47% rate.
Yeah, it's very piecemealed approach.
Yeah.
Well, thanks everyone for... Sorry, you go, Andrew.
No, I saw some comments saying, look, it's something, but this is not a wholesale reform.
Yep. Thanks for 180 of you that responded to our little poll. Which of the budget announcements did you find the most interesting? 66% of y'all said it is the minimum tax on discretionary trusts. Thanks for that. So before we jump into Q&A, if you found this session insightful, I'm confident you'll find value in a Tax Nugget subscription. Andrew Henshaw has a lot more content on our platform as well. And so I'm just going to launch a poll. Let us know if you'd like to learn more about us, and we'll follow up and let you know how you can get onto a free trial, which gives you unlimited access to our entire platform. All right, we've got 5 more minutes, so I'll take a couple of Q&A. And the biggest one that keeps repeating multiple times is, will this get passed in Parliament? Which ones do you think is likely and which
Yep.
ones are unlikely? Andrew, to help
Yeah.
us sort of
Very
manage
happy.
some of these uncertainty.
Yeah, disclaimer that these are my predictions and I know no more than any of you.
Don't you have a crystal ball?
Oh, yeah, I've got the crystal ball in the back. Look, I think negative gearing, I would say 95% chance of getting through, as is. I don't think that's going to change. Yeah, that's my prediction on negative gearing. 50% discount, 75%. That's it. I think it probably will. I think it probably will go through. Maybe there'll be some tweaks around the edges, and there'll definitely be something for. It just doesn't feel right to me that private businesses would be taxed the same as speculators in residential property. It doesn't feel right. Like, what's the point in running a business, etc., if you're going to get taxed at 47% on the exit? So I think there's going to be something there, but I think that will be the next of the big ones to get through. The tax on trusts, it's really hard. I think it's going to get into a political issue, and even just to write the legislation, you've got to think about like 100 different situations and how it's going to work. Like, it's a massive job. So I don't know. Let's say 45%. Yeah.
So that's probably the lowest confidence that it will go through.
And all the other ones, 100%, 95% on all the other ones.
Yeah. Okay, hopefully that's helpful for those that are still with us. I saw a few questions about excluded trusts. Widely held trusts, what's that? And unit trusts, are they fixed trust? Andrew, can we now convert all discretionary trusts into fixed trusts?
Yeah, I think the answer is no. I mean, it's stated that this won't apply to fixed trusts. Most unit trusts are not fixed trusts. I don't know whether they're intending unit trusts to be in, or there's like a deeming, or how there is for a lot of other rules about what's a fixed trust. Can you convert a discretionary trust into a unit trust? Yeah, you can if you want to. Lots of consequences from doing so. But if you've got the ability to just move into a company, why don't you do that? Unless there's some other massive thing that's preventing it.
Yeah. Understand. And I'll just take one final question. With regards to, this is a negative gearing one. With regards to properties being purchased before budget night, like, what do you look at? Contract, settlement, first date of rent?
Contract. Yeah.
Contract. Yep.
I don't know off the top of my head how it works with a nomination that's happened after contract date. But I would think that it still will go back to contract date, even if it's a nomination afterwards. So contract date.
Yep. Amazing. And apologies, we can't get through the 126.
I think there was one other one I'll add. I think I saw one that was interesting, say that with the 30% tax, what if you've got a dividend at 25%, how will that work? So let's say the discretionary trust gets a dividend and it's been franked at 25%. Then the trust will they get the imputation credit for the 25%. And assuming it's going out to an individual, basically the trustee would pay the extra 5% on the way out. And then the individual beneficiary will get a credit for the 30% then.
Yep. That makes sense.
Yeah.
Awesome. It is time for our giveaway with the final minute. Give us your best budget hashtag in the chat. And Andrew, you're going to have to choose. That's a very tough gig. So I'll let you have a look. You can pick more than one if you're struggling.
Yeah. There's
oh my gosh, I can't even read. It's going too fast. Hashtag had to happen. That was nice.
I mean, how many negative ones do you want me to pick out of the three? And, look, I think,
𝗧𝘵𝗺𝗴𝗴𝗲𝗁 is really good.
Hashtag, well, let's pick this one to be controversial. First, hashtag move to Dubai. I think it really means that if you're a non-resident, you already had a lot of differences in tax treatment, and it's even more so now. So I'll give one to move to Dubai. That is
Very nice. Congrats. We'll look up who said that and reach out to you and yeah, get your address and ship that to you.
I'm going to give one, because I'm a massive Simpsons fan, I'm going to give one to Super Nintendo Chalmers.
Well done, Super Nintendo Chalmers. We'll get in touch. And maybe one lucky last. Well, there's move to Singapore as well, but I don't know. Move to Dubai just sounds better for some reason.
Yeah. And I'm going to give it to hashtag bye-bye corporate buckets, just for the accuracy. There's also 200 more messages in here, which I haven't read yet, but I'm sorry that it's just, there's just too many messages to read.
No worries. So yeah, congratulations bye-bye corporate bucket. We'll reach out to you as well. Habibi, we've come to Dubai. That's hilarious.
There's one. I'm going to get an honorable mention to one. Velocity will be busy. I think all tax
there we go.
will be very busy.
There we go. You get a little DJ air horn for that one. No mug, but yeah, special sound effect there. RIP Trust as well, potentially. I don't even know what's going to happen to FTEs. Nobody would care about them anymore, potentially. Yeah, but thank you so much for joining us, everybody. Thank you so much, Andrew, once again. And, you know, hopefully you found this super insightful. We'll follow up with a copy of the cheat sheet and presentation slides and recording as well. And on behalf of Tax Nuggets and the team, thank you for spending your time with us and hope to see you all next time.